So what is accounting? Accounting is the process of tracking financial transactions and reporting the results of those transactions. A financial transaction occurs every time that money or something of value moves in or out of a business or organization. Examples of financial transactions include making a sale, delivering a product to a customer, converting raw materials into a finished product, buying advertising, paying employees, receiving loan money, making a payment on a loan, paying rent, buying office supplies, collecting taxes, and much more. Tracking financial transactions is called bookkeeping. Once financial transactions are recorded, financial reports can be generated to display the results of those transactions. Okay, so we've learned that accounting records financial transactions, and anytime some cash or something else of value moves in or out of the business, we're going to record that. That's what accounting does. And that's what we've been doing here in making these decisions. When I've chosen to invest money in advertising, that is a financial transaction. When we purchased our inventory, we order our inventory and we've already got the inventory on order, that is a financial transaction. So what we're going to do now is we're just going to continue and actually run this business and see what happens. So we've got our products, we've got our inventory, we've got our kiosk, we're located here in the shopping center. Let's go ahead and open for business and watch customers come. So there we go, we've opened for business, and these little dots actually represent our customers, and we can hear every time we're making a sale, and we can see customer feedback, whether our customers are happy with our product, our price, our quality, our speed of service, and so on. So far it's looking pretty good for us. So we're going to continue watching these sales and monitoring our customer feedback as we run our business. Now remember, customers are giving us money in exchange for our product, which in our case is ice cream. So that money that the customers are giving us is called sales, or sales revenue from an accounting perspective. And we'll see how all of that fits in to our accounting model in a moment. Now here's our results for the end of the day. We've served 26 customers. We've lost 57 customers. That's part of business as well. Sometimes you lose customers. We won't go into that detail because we're focused on accounting here today. And we've sold 45 products. Our sales revenue. Now sales revenue is a term used in accounting to represent the money that customers give us for our product or service. So these 26 customers gave us $121. In this case, it would be cash. Sometimes it might be a credit or some other method, but we've earned $121 in cash from these customers, and that's classified as sales revenue. That's a financial transaction that accounting monitors. And we have a cost of goods of $45. Now, cost of goods doesn't tell us the whole story, because what is cost of goods? That is the cost of the ingredients that we used to make the products that we gave to these 26 customers. So those ingredients cost us $45, and customers gave us $121 in return because we packaged those ingredients into a finished product. Now, we purchased a bunch of inventory. We didn't sell all of our inventory. The cost of goods sold only reflects the amount of inventory that we sold to these customers. We still have some ingredients, some inventory remaining, which is unsold. That is not reflected in cost of goods sold. And the next number we look at is gross profit. So $75 is our gross profit. So that's $121 of revenue coming in minus the $45 of value we put out for a total of $75 in gross profit, and the gross profit margin, which is the 75 divided by the 121 times 100%, gives us a 62% gross profit margin. Now in business though, gross profit doesn't tell us the whole story, because there's other expenses, other things that cost us money that are not reflected here. So don't think that we've walked away with $75 in cash. We have not. Let's take a look at another report, which is called an income statement. We're going to go into an income statement in more detail later, but let's just look at the high level of the income statement. So we can see the sales revenue of $121. There it is totaled here. That's how much money customers gave us. Our cost of goods, $45. That's the cost of the ingredients we used to sell those products. for a gross profit of $75. So that's the same information we saw on the previous window. But let's move down to what are called expenses. And let's take a look here. Okay, we have one expense today. That's our sales and marketing. Remember, we spent $20 on that social media search marketing or advertising. That cost us money. So we have to subtract that from our expenses of the day. So let's scroll down. Oh, we also had some inventory spoil as well, or get damaged along the way. So that's an expense of $1.90. So our total expenses are $21.90. So if we take the $75 in gross profit and we subtract those expenses, our net result is $53. That is our net profit. That is how much money we've completed the day with. So it actually was an okay day in that we did make money, but not as much as the gross profit might tell us. It's really the net profit that's the important number here. So now we're going to learn how all of these numbers are generated and tracked through accounting. So we're back at our virtual business, and we've learned that accounting tracks financial transactions or changes of value in a business. Earlier we looked at our income statement, which showed us our profitability for the day. Now, where did these numbers come from? How is this report generated? It's all generated through accounting. So what happens is every time there's a financial transaction in business, and remember, a financial transaction are things like purchasing inventory, or paying employees, or conducting or spending money on marketing. Every time that there's a financial transaction, that's logged in a report called the General Journal. So this is the General Journal, and basically it is a log of every transaction that happens in business as it happens. So it's dated based on the time that you have had that transaction occur. And if we scroll down to the bottom, we actually can see it in chronological order. It starts at the bottom and moves up. So we can see when we first started our business, there was an $8,000 transaction. That was money, in this case it's called startup capital, that was put into the business to start the business by the business owners or shareholders. And so that's recorded in our log, our journal here, as an increase in our cash of $8,000. And then after that, we actually purchased a kiosk, which is under property, equipment, and startup, and that cost us $3,000. And then after that, we did some startup activities like permits and licenses and registrations, and that cost us $2,000. So as you can see, as we go, every transaction is logged in this journal. Now you see the numbers are duplicated here, and that's based on double entry accounting. That's another concept of accounting we'll talk about later. But right now I just wanted to show you that everything is tracked through this report called a General Journal. Now the General Journal, as useful as it is to track every transaction, it's not as easy to kind of pick out the information that you want. That's when we revert back to a different report called the General Ledger. So the General Ledger has the exact same info as the General Journal, but it organizes things in a way that's easier to understand. So what it does is it categorizes different types of transactions into accounts. So for example, here we have our cash account. So everything that's related to cash, every time cash increases or decreases, so every change is recorded first in our journal, because remember that's a running log, but then it's organized or reorganized into our ledger so we could just see all of the transactions related to cash. So it's just a way of filtering transactions. The other benefit of the ledger is it also has what's called a balance, which is this column here. So looking back at the start of our business, again this is in reverse order as well. So the first transaction in our business was the $8,000 in startup capital or seed funding needed to start the business. So what we see here is a running total or a balance of that account. So it was zero, and then it became 8,000 once we received the $8,000 in the business. And then we purchased a kiosk and made a payment in cash for that of $3,000. So that's reduced our cash by that amount. So now we are down to $5,000. Then we did some startup services, which reduced it by another $2,000. So now we're down to $3,000. We purchased inventory, reduced it again by $85. And then there's our balance. And then, some good news here, we actually started selling and we sold our products to customers. So customers gave us $121, and now that increased our cash. And then we reduced again by $20 because of the advertising charges. So as you can see, it's just a running total of everything, and the ledger organizes things or classifies things in categories, so it's a little bit easier to follow the accounts. Now what you're seeing here is two columns, one called a debit and one called a credit. That's an accounting term used in double entry accounting, and basically just represents an increase or a decrease in an account. So in the cash account here, when we increased cash, it's called a debit, and when we decreased cash, it's called a credit. It's a simple concept, although one thing that's a little bit complicated about it is it can be reversed. So a debit could be a decrease and a credit could be an increase based on the type of account. But that's beyond the scope of this video, so we won't get caught up in the weeds on that one here today. But let's focus on simply the fact that this is recording every time a transaction happens. And we can jump to other categories or accounts, like inventory, for example. So here inventory is tracked. So we started with no inventory, then we purchased inventory. So now we had this asset. An asset is a thing of value. Cash has value, inventory has value, equipment has value, land has value. So we now have these valuable assets of inventory, which we paid for in cash, $85 in inventory. Remember that $85 up here? There it is here. So this is the same posting, just listed in multiple places where it applies. So we purchased inventory, and now we have an inventory asset of $85. But then we sold the product to customers, not all of the inventory. We just sold our cost of goods. You may remember that from the earlier video, and that was $45. And so that reduced our inventory on hand to $39. And then we had some damaged or spoiled items, and so that reduced our inventory asset again. So as you can see, it's a simple concept of tracking transactions with simple math: increase, decrease, add, subtract. Very simple. And there's just simply accounts for different aspects of the business, from taxes and loans, and whatever your business specifically needs to track, you just create an account for it, and that's how it's tracked in accounting. It's as simple as that. And originally, this type of tracking was all done in paper logs and books, in actual physical books with pen and paper and so on, and you write it. And still a lot of businesses still use those paper books, but most businesses have moved to using spreadsheets or accounting software itself or other apps that are designed to track. And once you have that software in place, it makes it a lot easier to pull these numbers and generate the reports that we saw earlier, like that income statement report. And all those reports that we're going to talk about in another video basically just pull numbers from the general ledger, as you see here. Let's look at accounting and financial reports. So in our previous video, we looked at how accounting tracked financial transactions and changes in value using a report called the General Journal, which is a log of all the transactions in our business. And we also looked at the ledger, which has the same information but organized a little bit better and categorized by accounts. That makes it a little bit easier for us to follow specific types of accounts like cash and inventory and so on. So now once we have all of our accounting working properly, or all of our data in place, how can this help us make better business decisions and manage our business better? It does so by allowing us to generate reports that use that data. If we have it all in a software application or accounting application, with a couple of clicks, we can generate very useful reports. So let's look at some of those reports. We'll start with cash flow. So cash flow is perhaps the most important thing you have to monitor in business, because it tells you if you're going to potentially run out of cash or if you're growing your cash and so on. And of course, running out of cash is the biggest problem you could experience in business, because if you don't have money, you cannot operate your business. You can't purchase inventory, you can't pay your employees, and so on. So cash is very important. And what this report does is it simply shows us if we're ending the day with more or less cash than we had at the beginning of the day, and what our overall cash is. So what you can see here is money in minus money out gives us the total difference for the day, and then running balance of cash for the day. Now we've only run this business for one day, so we just have 1 day's worth of data. Let's look at it. So money that came in was $8,121. Where did that money come from? Well, you may remember that $8,000 was from startup capital or seed financing, and then we generated some revenue from customers. So that's where that money coming in. Money going out was buying our kiosk, startup services, buying inventory, some inventory spoiling, and so on. And we ended the day with $3,035, and that's our balance. And that's the amount of money we have at the end of the day. And we can track this day by day to see if our cash is increasing or decreasing. If our cash is decreasing, that's a red flag. We got to keep track of that and forecast if we are going to run out of cash. If we're going to run out of cash, we got to take action before we do. Maybe we'll try to sell more products and have a sale, or be more aggressive in our marketing to increase our sales, and hopefully in a profitable way. Other options might be to take out a loan to bring money in and borrow money and bring money into the business, or sell shares in the business that will bring money into the business to allow us to get to the point where we're profitable and the main business is generating positive cash flow for us. So cash flow, critically important to a business, and you can look at that with a cash flow report. The next report we'll quickly look at is product sales and inventory. So we're selling products. We have to have inventory on hand in order to make those products. Otherwise, we can't make a product and can't sell it. Customers won't pay us for it. So we have to track how much inventory do we have on hand? How much inventory have we been using? How much inventory is being used to make the products that we need to sell? So using a report like the one you see here allows us to see what our sales have been and how much inventory we've been using, how many products are going to customers, and it allows us to forecast when we might need more inventory, when we should purchase that inventory, and so on. So similar to cash and monitoring cash, to make sure we don't run out of cash, we also want to make sure we don't run out of inventory, and then we can forecast that going into the future. So product sales and inventory is very important. Now let's look at the income statement. The income statement, sometimes it's called a profit and loss or a P&L statement. And the income statement allows us to see if our business is making money or not through the operations of the business. So we look at money coming in from customers and similar sources, money going out, and then what's the result? Is it a positive number, which is profit, or is it a negative number, which would be a loss? Now this sounds a little bit maybe like cash flow, but cash flow specifically looks at cash only. The income statement gives you a breakdown of everything of where your money's coming and going, and it's specifically though to the operations of your business in terms of selling a product or a service. There are some numbers that may not appear here that might appear in the balance sheet, which we're going to look at in a moment. So the income statement is revenue, money received, minus cost of goods and expenses. That's money you're paying out to create and deliver your products to customers. And the result is profit. That's money made or lost. And we can see based on our current numbers, we had 121 in revenue, 67 in cost of goods and expenses, and that resulted in a net profit, that's a good, of $54 today. So let's look at a breakdown of those numbers. So revenue was sales, $121. Other income would be revenue that generated by our business through other sources, but in this case we're not selling anything other than our ice cream, so we have no other revenue. If we did take out a loan or we sold shares in our business and money came in that way, it actually would not appear on the income statement. It appear in our balance sheet, but not in our income statement, because our income statement is focused on generating what's called revenue. Loan money and money from selling shares is not revenue. Then we have cost of goods. So remember, the cost of goods is the cost of the ingredients, so the inventory needed to make the products that we've sold for, in this case, for $121. And here it's $45. Transportation, if it costs us to actually transport our ingredients or inventory to get it on hand, that would be considered a cost of goods. That's different than other types of transportation where maybe we're driving our car somewhere and we're incurring expenses in that way. That would be an expense. But here, it's related to our ingredients or inventory, so it's a cost of goods. In this case, in this simplified simulation, there is no cost, so that's why it's zero. So $45. So our gross profit, which is simply the revenue minus cost of goods sold, is $75. Then we have to consider our other expenses. And you may remember we spent $20 on advertising, so that's reflected as an expense. We also had some of our inventory spoil or get damaged. $1.90 worth of that was incurred. And so we add all that up and we have $21.90 in total expenses today. So that's in addition to our cost of goods up here. So when we add our cost of goods and our expenses and we take those numbers and subtract them from our revenue, we will get the bottom line number, which is profit. That's the most important number here, is are we making money? And in this case, it's $53, a net profit, a positive net profit. Now you'll notice this says loss in parentheses or brackets. If a number in accounting is shown in parentheses or brackets, that means it's negative. So instead of showing a little negative sign in front of the number, you'll often see it in brackets or parentheses. And that would indicate a negative number. In this case, it would indicate a loss in profit. We actually lost money on our sales. but in this case it's positive, so that's good. So that's what the income statement does, is it takes all of those financial transactions that were recorded for sales and cost of goods and brings them together into this one report, and we can see whether we ended the day with making money on our sales or losing money. If we're losing money, of course, we have to consider things like, is our price too low? Do we need to raise our prices? Is our inventory cost too high? Do we have to find suppliers that offer lower cost inventory? Are our expenses too high? Do we have to cut back on some expenses? And that's what the income statement will allow us to see. Let's look at the balance sheet. So the balance sheet gives us a snapshot of the overall value or financial state, financial health of the business. And what it does is it has a simple formula. It's assets minus liabilities equals equity that you see here. Another way of explaining that is simply take everything that your business owns, subtract everything that your business owes, and that results in the value that you've created in the business, or in this case called equity. So assets minus liabilities equals equity. And these things always have to balance. So you'll see here our assets in our example is $8,054. We have no liability, so we don't actually owe money to anyone, which is great. And so our total equity is also $8,054. It balances out. This formula, assets minus liabilities equals equity, it should always balance. If it doesn't balance, it's actually an indication that there's a financial transaction posted incorrectly in our accounting, and we have to correct that. So numbers on the left-hand side here should equal the number on the right-hand side here. So let's take a closer look at what those numbers are. So assets are things of value, and that includes cash. In this case, we have $3,000 in cash. Accounts receivable would be money that's owed to us from customers. In this case, the customers all paid us up front, so they don't owe us any money. Inventory, that has value, and so there's the value of our inventory. Transportation, that would be related to the inventory. That would be considered value as well, but in this case, we don't have any transportation value. And then we have our property, equipment, and startup. So this $5,000 represents the $3,000 paid to purchase our kiosk and the $2,000 in startup, setup, and other costs that we had to incur to start our business. Sometimes those costs, by the way, are put under expenses for some businesses, but in this case, it's considered an asset. So everything that we own that has value is here as an asset, and it totals $8,053. Now, everything that we owe, accounts payable, that's money we owe to other businesses. Maybe when we purchased inventory, we didn't have to pay for it right away, and the supplier would let us pay for it later. Or maybe we put something on a credit card, pay with a credit card. These are things that we would owe and have to pay. In this case, we have none, so it's zero, so that's great. And then we have our equity. So equity is money coming into the business related to a couple things. So one is, when we started our business, we invested seed financing, the owner of the business, or in this case us. We invested $8,000 of our virtual savings into the business, and that gets represented as equity because it's not money that we loan to the business. If it was loaned to the business, it would appear as a loan under liabilities because that would mean it's money that has to be paid back. But this $8,000 does not have to be paid back. It was given by the owner of the business into the business in return for shares. That's the ownership of the business. So we own 100% of the business because we put all the money in to start the business. We didn't have any other partners or other shareholders owning the business. If we were to sell shares again in the future, it might appear on a separate line just to separate it out from the startup capital. That's simply why it's on two separate lines here. If shares in the business were sold again in the future, it would appear here. And finally, we have retained earnings. Retained earnings is just another word for profit. So it's a cumulative profit created in the business. So it's the cumulative net profit generated by the business. So if we were to go back to our income statement and look at the bottom net profit number, and we just kept that number accumulating over time as we run the business, that's what appears at the bottom of the balance sheet here as retained earnings. Earnings is just another word for profit, and retained means it's kept in the business. In other words, the owners of the business, the shareholders of the business have not taken the profit out of the business, and therefore it's retained. So retained earnings simply means cumulative net profit that still remains in the business, and that's what this number is. So when we take all of our assets, everything that we own, minus liabilities, everything that we owe, that's the overall value of the business. Now, If you were to sell your business, you may not sell it for exactly this number because there's other considerations that are beyond the scope of this video, which I may talk about in another video. But in this case, that's what equity represents, is the value of the business in the balance sheet. So you can quickly look at the balance sheet to see everything that you own minus everything that you owe and how much value you are building in the business. And those are the primary financial statements that you can generate through accounting and to help you make better business decisions.